When it comes to building wealth through investing, the power of compounding is often hailed as the most effective strategy. It's the financial magic that turns small investments into significant wealth over time. If you aren't new to the channel, we have discussed different rules of compounding. The 8-4-3 rule that enables you to double your investments in just 4 years, for investments that offer an 8% rate of return, and the 5-5-3 rule that enables you to double your savings accounts with a rate of return of 5% in 5 years. If you haven't watched the videos, I would really recommend watching them. In this video, we will be discussing the 7.2 rule of compounding that will enable you to double and multiply your money invested in an index fund. The 7.2 rule of compounding is rooted in a fundamental principle of finance called the Rule of 72. The Rule of 72 is a quick and easy way to estimate the number of years required to double your money at a fixed annual rate of return. By dividing 72 by your annual return percentage, you get a rough estimate of how long it will take for your investment to double. Now, the 7.2 rule is a specific application of this broader concept. In this context, 7.2 represents the approximate number of years it takes for your investment in an index fund to double when your average annual return is about 10%. Why 10%? The truth is, 10% is the average annual return you can expect from investing in a well-diversified index fund. Over the last century, the S&P 500, one of the most popular index funds, has delivered an average annual return of about 10% before accounting for inflation. This average takes into account the ups and downs of the market, including economic booms and busts. While this 10% return isn't guaranteed year after year, it's a reasonable expectation over the long term if you're investing in a well-diversified index fund. Before diving deeper into the 7.2 rule, let's talk about why index funds are an ideal vehicle for this strategy. So, why index funds and not individual stocks or other types of investments? Well, investing in individual stocks can be like trying to pick a winning lottery ticket. Sure, you might get lucky and choose a stock that doubles or triples in value, but you're just as likely to pick one that underperforms or even loses money. Index funds, on the other hand, take the guesswork out of investing. Index funds are mutual funds or exchange-traded funds, ETFs, that aim to replicate the performance of a specific index, like the S&P 500. They offer broad market exposure, low operating expenses, and relatively low portfolio turnover. They also offer several advantages that make them particularly appealing for long-term compound growth. First, index funds are diversified. When you invest in an index fund, you're spreading your money across a wide range of companies. This reduces your risk because you're not relying on the success of a single company or a small group of companies. If one company in the index performs poorly, it's often offset by better performance from others. Second, index funds have low fees. Because these funds simply track an index rather than trying to beat it, they don't require expensive research and management. This means lower fees for you, which can significantly impact your returns over time. High fees can eat into your profits, especially when you're investing for decades, so keeping costs low is crucial. Thirdly, index funds are passive investments. You don't need to spend time researching stocks, timing the market, or making frequent trades. You simply invest and let the market do the work for you. This hands-off approach is not only convenient but also reduces the emotional stress that often comes with active trading. Now that you understand the basics, let's break down how the 7.2 rule actually works in practice. Let's say you invest $10,000 in an index fund that averages a 10% annual return. In 7.2 years, your $10,000 will double to $20,000, and this is without you adding any additional funds. And if you do contribute an additional $500 every quarter of the year, that is 4 times a year, which is after every 3 months, then that amount will also double to over $40,000 after 7.2 years. Let's extend this over a longer period to see the compounding effect in action. After 14.4 years, your $10,000 would double again to $40,000. And with the $500 additional contribution, that will be over $105,000. As for 21.6 years, it would double again to $80,000, and with quarterly contributions that will be $240,000. And if you let it stay for 28.8 years, it would double once more to $160,000, and with the additional $500, then that amount will be over $500,000. That's the power of compounding. With and without additional contributions, your initial $10,000 investment could grow to $160,000 in less than 30 years, without adding any additional contribution, and over $500,000 with additional contributions with a 10% annual return. Understanding the 7.2 rule is one thing, but implementing it effectively is where the real challenge lies. So, here's a step-by-step guide to implementing this rule in your investment strategy. 1. Start early. As always, the earlier you start investing, the more time you give your investments to compound. Even if you can only start with a small amount, starting now gives you the advantage of time, which is crucial for compounding. 2. Choose the right index funds. Look for index funds with a strong track record of returns, ideally averaging around 10% annually. Also, choose low-cost index funds because high fees can eat into your returns, diminishing the power of compounding. Opt for index funds with low expense ratios to maximize your compounding potential. 3. Invest consistently. Regular contributions to your investment account, whether monthly, quarterly, or yearly, even small ones, can significantly enhance the compounding effect. Consider setting up automatic contributions to ensure you're consistently adding to your investment. 4. Reinvest your dividends. Many index funds pay out dividends. Instead of cashing out these dividends, reinvest them to take full advantage of the compounding process, helping your money grow even faster. 5. Stay the course. The power of the 7.2 rule lies in patience. Markets will fluctuate, and there will be times when it feels like your investment isn't growing as quickly as you'd like. Stay focused on the long term and let the compounding effect do its work. By following these steps, you can harness the full potential of the 7.2 rule of compounding, setting yourself up for financial success over the long term. Now that you are well informed of the 7.2 rule of compounding, let's look at the several key benefits offered by this rule that make it an invaluable tool for any investor. 1. Simplicity and clarity. It provides a clear, easy-to-understand timeline for how your investments will grow. This can be incredibly motivating, especially during periods of market volatility when you might be tempted to sell. 2. Wealth accumulation. With your money doubling every 7.2 years, you're on a steady path to significant wealth accumulation. This shows how your wealth is building up sustainably over time. 3. Financial discipline. By focusing on the long-term growth potential, the 7.2 rule encourages you to develop strong financial habits, such as regular investing and reinvesting dividends. 4. Retirement planning. The 7.2 rule can be particularly powerful when planning for retirement. By projecting how your investments will grow, you can make more informed decisions about how much to save and when you can afford to retire. 5. Financial freedom. Ultimately, the 7.2 rule is a path to financial freedom. By understanding and applying this rule, you can take control of your financial future, making your money work for you rather than the other way around. The 7.2 rule of compounding is a powerful strategy that can help you multiply and grow your money and wealth over time. By understanding and applying this rule, you can take control of your financial future, allowing time and compounding to work in your favor, and also set yourself on a path to financial freedom.